Hello and welcome to a Minnesota Banking Minute. I am Carla Bush with the Minnesota Bankers Association. Today we will be talking about equipment finance and leasing with our special guest, Jordan Kistner. Jordan is an attorney in the transportation and logistics and banking practices groups at Fafinski, Mark & Johnson. Jordan, to begin, tell me, what is the difference between a lease and a loan?
There are several differences between a lease and a loan. In a lease, the lender or the bank is actually the lessor and will own the equipment throughout the life of the lease. In a loan, the borrower is the owner of the equipment and makes payments to the lender to pay off the value of the loan. There are also differences in finance charges. In a lease, the finance charges are built in equally across each installment payment, meaning that each payment is going to be equal and there will be no variation in principal or interest. In a loan, you will see that traditional principal and interest or P&I structure, meaning that more interest will be paid up front and more principal will be paid at the end. Finally, the last notable difference is that there is different end of term options. At the end of a loan, the borrower is going to be the owner of the equipment outright, free and clear of all of those liens that the bank had previously secured in the equipment. And at the end of the lease, the borrower should actually have a few options. It should have the option to return the equipment to the lender. It should have the option to purchase the equipment from the lender, and it should also have the option potentially to extend or renew the lease if there's any residual value left.
Great. So tell me, how do I protect the bank's security interest in the equipment?
So generally, most lenders are going to look to Article 9 in the UCC to protect and secure their interest in the equipment that is being financed. I will say up front, though, that the UCC does not apply to all types of equipment that will be financed by the bank. It will be important that you look towards any of the rules, regulations, and laws that apply to specific equipment. Some examples of this equipment that wouldn't fall under the UCC are aircraft, vessels, and other equipment that would be covered under a certificate of title. So beyond that, though, the UCC is going to cover much of the borrower's equipment that is being financed. And what the bank will need to do to perfect that interest is file the UCC-1 financing statement in a jurisdiction where the borrower is located in most cases. And not only that, the lender or the bank will want to try to obtain a purchase money security interest, meaning that it will want to file that UCC-1 financing statement within the timing parameters and other rules provided by the UCC to get a priority first security interest in the equipment, meaning that they will jump ahead of any of the security interests otherwise obtained in the equipment by other third parties.
Thanks so much. Finally, tell me, what terms should every equipment finance agreement have?
Every equipment finance agreement should have the core fundamentals of any good finance agreement. It should identify the parties, it should list the payment structure and the payment terms, it should outline the term or the length of the finance agreement, and it should also list the events of default and available remedies to the lender when an event of default occurs. Now, an equipment finance agreement should also have specific equipment-related provisions. This includes insurance provisions that not only protect the borrower's interest in the equipment over the life of the agreement, but also the bank's interest in the equipment, so it can recover any of those damages and losses that may occur to the equipment while the equipment is being financed. It should also include a power of attorney provision so that the lender can take actions on behalf of the borrower or without the borrower to take certain actions that benefit the lender, such as obtaining a certificate of title or filing the UCC-1 financing statement. On top of that, the equipment finance agreement should specifically list in detail the type of equipment that is being financed. This includes make, model, manufacturer, serial number, or vehicle identification numbers. And to finish that up, the equipment finance agreement should also disclaim any and all warranties related to the equipment, meaning that the borrower should take the equipment as is in the condition it's in. The lender should not be on the hook for any recourse or any actions from the borrower to come back and say that it wasn't fit for its particular use or purpose.
Thank you so much, Jordan, for joining us today and for that excellent information. And thank you for joining us today. You can view all of the Minnesota Banking Minute videos on our YouTube channel. We'll see you next time.